Can you hear me okay?
Yes, I can hear you very well. Can you hear me okay?
Okay. Yep, perfect. Your audio is great. Okay, so this is kind of a continuation of the previous two calls that we've had with some presentations that you've made for us, and a continuation, I guess, also of a discussion that we were having on the coffee break, where, we kind of alpha leak this, slightly, I guess. So before we jump into it, though, maybe you can just give us a little bit of an update. Where does Carbon stand at the moment?
Um, well, um, uh, where, what do you mean saying? You mean with respect to development?
Yeah, I mean, I know that we can't get a date from you. I know that we're not giving any sort of a definitive timeline, or we're not going to get any sort of um, an exact date. That's not what I'm looking for. But are we still kind of on track development wise? Can you give us a little bit of something in that regard?
Sure. So, um, the we're in the process of organizing the auditors right now. And this is generally, the sort of the last step in the development process. We'll be looking to have a deployment on Tenderly in not too long. We're about to start the internal QA and and bug finding activities. Uh, so yeah, it's we're getting pretty close to the end of the development process.
Okay, awesome. Thank you. I see you are sharing your screen. So maybe before we jump into this, you can give a quick recap of the last two
Yeah,
presentations that we did that kind of led up to this.
I've already got it kind of in here, so I can just jump
Perfect.
into that.
Great. Let's do it.
Yeah. Yeah. Okay. So as Jen has said, this is sort of the something that I promised to deliver roughly 2 weeks ago. And on that presentation, I basically, I presented these slides. I've just chosen two or three of them, I think. But essentially, I was comparing how asymmetric liquidity holds up against constant product, and I said that I would be comparing that to concentrated liquidity pretty soon. I just needed some time to, to get the code base completed. But in that demonstration, we had this situation where Alice was someone who was using, dual bonding curves and using asymmetric, carbon liquidity in order to place separate buy and sell ranges. Bob was using standard constant product, and Charlie was a HODL. And then we used this price chart, which was something I just made up, right? There's this, any resemblance to any actual price activity is coincidental. This was just a random number generator that I used just so that I had something to work with. And then we had a look at, how these strategies performed, and, saw that Alice was able to net a fairly healthy, profit for herself. And of course, that's not entirely surprising, right? Buying something low and selling it high is sort of the most fundamental of economic primitives. And that's exactly what Carbon is empowering people to do, right? I think that the more we repeat that Carbon is a buy low, sell high protocol, I think the more people will realize exactly what its value proposition is, and also that there aren't really any other protocols that service that need, which is surprising. Okay, so on this presentation, I'm going to do what I wanted to do 2 weeks ago, which is have a look at things in a lot more, present, first of all three of those comparisons, but also in a lot more detail and using, I think, heuristics and real world examples that are going to do Carbon a lot more justice than that last example ever did. Okay, so we're no longer in that swing period. I'm going to be doing constant product, concentrated, and asymmetric. And of course, when we're talking about regular concentrated liquidity, Carbon is in itself utilizing a type of concentrated liquidity. But what I mean by concentrated liquidity is the Uniswap V3 like system, right? So there are a couple of different versions of this. I would say the two most prominent examples are Uniswap V3 itself and Trader Joe's sort of Uniswap V3 clone product, which it's not quite a clone, that's not doing a lot of service, but it is similar enough that we can treat those systems as belonging to a certain class. And that class I'm just referring to here as concentrated liquidity protocols. So rather than just look at sort of payoffs and things, what I'm going to be doing in this presentation is actually introducing you to dynamics, because the software that I've created here, it actually has a lot more utility to it. And I think that it can be a much better learning experience if we actually have a look at how things evolve over time, rather than just having a look at the result of something at the end of some big calculation range. So similar to last time, we're going to be using a generic token that we designate with the symbol TKM, and we're going to assume that it is trading currently at $10. And then we're going to give 3 different liquidity providers. There's no HODL this time. Each 1,000 of those TKNs and 10,000 USDC, which means that they have $20,000 in total value each. One of them is going to go to constant product, and one of them is going to go to a concentrated liquidity paradigm. The other one's going to be using Carbon. Now, before we get into a real-world example, what I really want to do is just look at a sort of laboratory environment, right? Something that is going to give us an opportunity to observe the type of behavior that each one of these protocols exhibits that makes them distinct from each other. So I'm deliberately using a price chart that oscillates between $6 and $20. And on a constant product curve, you'll see exactly what that's going to look like. And I'm going to walk you through, what some of these pictures mean. So, don't be afraid. There's going to be 4 charts on the next slide, and I'm going to walk you through each one of them. This is the constant product situation. Jen, how is that animated, by the way? Does that look smooth, or is it kind of, is it a bit slow?
No, it's smooth. It's good.
Okay, good. So you can see this sort of sinusoidal-like, price pattern evolving through time. This actually is a sine curve. It's just, it's actually it's e raised to the power of a sine curve, which is why it looks kind of a little bit more pointy at the top and a little bit more stretched out at the bottom. But you can see it's doing exactly what I said it would do. It's oscillating between $10 and about $6. Okay, so what do these green and red colors mean? Well, this is essentially the available liquidity that's available on that liquidity provider's position. Okay, so if this is the liquidity provider that put all of that money into a constant product AMM at $10, then you can see that the green bounds, at least they should be, they extend all the way to 0, and the red extends all the way to infinity. And so the red color, this is the amount of tokens multiplied by their US dollar equivalent available at this point in time. And so as the price moves around, you can see that in the constant product case, it is always making sure that 50% of its total value is available between $0 and the current price, and the other 50% is available between the current price and an infinite price. And this is always that, where we get this weird effect on a constant product liquidity chart, where the red part, right, the available token liquidity in this case, looks like super short compared to the available USDC liquidity. And that's because in the way that we're drawing it here, where we've got the token price as the x-axis in the bottom left chart case, you have to remember that there's only a finite amount of space between 0 and the current price, but there's an infinite amount of space between the current price and infinity. And what's weird is that the area of both of those wedges has to be the same. So if you take something that's finite and stretch it out to infinity, of course it's going to get really, really short. And so that's what that's looking like. Okay, so that's those two charts, right? On the left-hand side, we've got a normal sort of price chart with the available liquidity superimposed on top of it. And then on the bottom, we've got a regular order book style liquidity depth chart. Now, on the top right, when you see the performance versus HODL, what you should be looking at is the fact that it's not performing very well, right? You can see it's kind of approaching break even fairly frequently, but then as soon as the price moves back past the initial price point, it immediately goes down, right? It is it doesn't matter which way the price goes, you end up with a poorer performance versus HODL. But it does drift up and to the right. And if you have a look at some of the economics papers that Bancor has published before, especially the ones written by Stefan Loesch, you will remember that this drift up into one side is linear in nature, right? So fees accumulate in linear time, whereas things like IL are generally only increase in square root time. And so this will actually continue. If we let the simulation run forever, that growth on constant product will actually it's a completely unbounded. It will just keep going up. Obviously, the market will run out of money eventually, but at least theoretically, in an infinitely liquid market, this will just continue to grow forever. Now, this simulator, it knows about fees and how to accommodate for them. So in the bottom right, you can see that we've got a fee earnings graph denominated in both USDC and TKN. And of course, because it's constant product, they're always going to be roughly the same, except for some small margin. And here, remember, the same as with the depth charts. I'm multiplying the TKN fees by its USDC value. And so that's why these things are roughly the same height, and why when the value of TKN is going down, generally the value of that rectangle is dropping with it. Now, working out exactly how many fees you have on a constant product AMM is kind of tricky. Anyone wants to get into the details of that with me later, please feel free to, you can stick around with me on Discord or reach out to me privately and I'll show you how to calculate it. But just know that it's a nuance of constant product AMMs, that the amount of fees that you have in each token is not constant. As the price moves, then the fee denomination actually moves with it, which is sort of a nuance of how these systems work. Now here I've actually set the fee to be, and so 0.3%, which is consistent with, I would say, industry standards. And one of the results of that is that you can see, especially in the liquidity depth chart, the red line and the green line don't quite touch, right? Which means that there is a small gap, which is equal to the spread of that constant product AMM. And this is one of the things that I don't think people have a very good understanding of, and that is that when you put a fee on an AMM, that fee effectively causes a spread to appear from nowhere, because whatever the buying price is for a token, its selling price will be different, and that difference will be equal to 1 minus whatever that fee coefficient is. Okay, and so this is I think a fairly good, fairly visceral way to understand how a constant product AMM works. And so now we're going to have a look at how that sort of simulation and visualization can help us understand concentrated liquidity dynamics. And so with a concentrated liquidity system, obviously we can't do a direct heads-up comparison because we need to start making some decisions. We know, for example, that with 1,000 TKN and 10,000 USDC contributed to the constant product AMM, that we want to sort of keep that component the same, but we need to we do need to decide how far up and down we want to concentrate the liquidity. And so here I've chosen the numbers $6.60. This includes the fee, by the way, and 15.15. If you take the geometric mean of those two numbers, by the way, you'll find it's equal to exactly $10. And so this means that the concentrated liquidity system will start off with exactly the same token balances as the standard constant product AMM will. And this means that we can make better comparisons, but because of that concentration component, we have to remember that it's not exactly the same. So some really striking differences appear almost immediately. One is that the green and red bars, which indicate the available liquidity for this market, are now bounded, right? And remember, this is just a single liquidity provider's position, not the entire protocol. And you'll see as well that we have that same spread, which is also caused by the fee. I've also used a 0.3% fee in this case as well. But you can see how as the market price moves through the range, it will flip it from, in this case, red into green. And then as the price traces back through from roughly $16 back to $6, it will flip it from green back into red. And then that is also represented on the bottom left in the liquidity depth chart, where you can see this white line representing the market price is kind of dragging, the red wedge behind it. And then when it oscillates back the other direction and depletes the TKN liquidity, that's when the USDC liquidity comes back again. And so this is what you'll hear, people that use Uniswap V3 all the time refer to as going in and out of range, right? And in a way, this is quite a good system to be looking at, because this is the type of behavior that they hope a market will have. They don't necessarily want it to go that far out of range, but they are hoping that they do kind of get this, this kind of oscillating behavior, moving neither trending to the upside or to the downside, but mostly just moving sideways, right? And this is where they get the most volume and the most fees from. And so you'll notice on the performance versus HODL chart as well, that because they are getting significantly more volume from this system, and by the simulator auto corrects for volume, you'll see that the way that the performance of this protocol is moving is actually at a slightly faster gradient compared to constant product, but it comes at the cost of a much greater downside risk as well, right? You can see, for example, here we go immediately to a minus 25% compared to HODL. It wasn't nearly that dramatic for constant product. The other thing you'll note here is that I'm using the Uniswap V3 model as the prototypical concentrated liquidity model, where the fees are actually accumulating outside of the available liquidity. So in the standard constant product case, the fees just become a part of the available liquidity, which is why they had that sort of pseudo 50-50 split permanently. But in systems like Uniswap, the fees accumulate somewhere else. And that means we track them differently. And so this oscillating nature of the TKN price also causes the fee value to oscillate with it. But this is, I think, again, a very helpful visual if you're studying these protocols and want to understand how they work. And I want you to, before we move on to asymmetric liquidity, just really appreciate what's going on with this flipping into green into red and how that whole range is covered, right? On concentrated liquidity protocols, you choose a single range, and the liquidity that you provide is evenly distributed across that range into both buying and selling, right? In a sense, that range is both a buying curve and a selling curve simultaneously. So asymmetric liquidity dynamics are, of course, the one that's much closer to our hearts, because this is the major innovation associated with our invention disclosure, and is the beating heart of Carbon. So with asymmetric liquidity, remember I said it is similar to concentrated liquidity in the sense that you are not stretching your liquidity infinitely far in price range. But it's asymmetric in the sense that you can choose how that range distributes buying and selling. And so what I'm going to do, again, to try and get a much fairer comparison between all three of these protocols, is I'm going to use the same bounds as that Uniswap v3 or that prototypical concentrated liquidity protocol. And I'm just going to split it right down the middle. So I'm going to take the low bound and up to the current price, which is $9.90, I think, and then I'm going to extract this upper bound as being the selling curve. And so what this means is that whenever the price is between 990 and 660, that is when USDC is being exchanged for, in this case, TKN by the maker, right, by the person who bought the sword. And whenever the price is between 1010 and 1515, then that is when the TKN liquidity is going to be exchanged with USDC. Okay, so some striking differences already. Notice that when the price is moving through this range, it doesn't drag the liquidity all the way with it. Okay, so those buying and selling regions are being respected by the protocol at all times, and that means that you have this kind of this weird piston-like behavior. So in the standard prototypical concentrated liquidity case, as soon as that price re-enters the range, that's when that liquidity would start to appear behind it. And in this case, we see that it actually has to make it all the way back to the halfway point to then re-enter that designated buying or selling zone. And it doesn't use the other one implicitly for that purpose. So this is the essence of asymmetric liquidity, and I do think that this is probably the best visual that we've had so far for depicting that exact behavior. A couple of things to pay attention to here. First one is the liquidity depth chart, and this is going to, this is probably going to come up in a couple of different contexts over the next few weeks. But what I want you to appreciate here, and it also applies to the chart above it on the price chart, is that when that first little piece of, in this case, TKN is being sold, the USDC that it is sold for, it appears at the lowest price, right? It appears at the far end of the price scale. It doesn't fill up evenly, if you like, between $6.60 and 10. It actually first appears at $6. And so you can see what I mean here, just as the white line starts to move past $10. Bear with me. Okay, so the white line is now approaching $10. And see how that green triangle, it grew from the left bound towards the center. And it's going to do the same thing here, right? As the green triangle depletes, the red triangle grows from the right left towards the center. And this is important for a number of reasons, but I don't think that we need to get into that necessarily on this call, but just let that sort of let that sit with you for a little bit, because it is going to have a role in how we set up strategies and what those strategies do and how they behave. And I've got a really good example in just a minute. In the top right, this is the most striking difference, right? In both of the constant product and concentrated liquidity protocols that we saw before, it was kind of difficult to get a performance that was, that was performing consistently better than break even. Whereas because of the increasing spread in the asymmetric paradigm, this thing actually grows exponentially. Now, that's not to say that you can rely on exponential growth in a system like this one. And again, I have a really good example coming up in the next slide, in fact, where that assumption will be rigorously tested. But what it does show is that given the same price chart with the same starting balances and the same range as a normal concentrated liquidity protocol, the asymmetric version, it outperforms it hands down. And that's interesting. And what's even more surprising about this is that the fee earnings that you see in the bottom right, that's actually not being used to measure the performance of this position. Why? Because on Carbon, the fees go to the protocol, not to the liquidity provider, right? On Carbon, the spread is where the profitability comes from, not the fees. So the fees here are the thing that goes towards buying and burning BNT, or at least that's what's going to be proposed. And it's what you're seeing here on the performance versus HODL chart is just the raw power that you get from splitting the symmetry up and having separate buy and sell curves. And like I said, I'm doing nothing special here, right? There's no advantages given to this system that weren't afforded to the other two, except for this asymmetric paradigm. And I will be open sourcing this, right? This will be something that you can all audit yourselves. It produces its own report in plain English so that you can read step by step exactly how these calculations are done should you want to. But yeah, I'm really excited actually to get more eyes on this, and I think that with this tool we can actually do some really interesting financial analysis and also learn how to trade markets better as a community. Okay, so now it's time to acknowledge, right, that it's one thing to have a sinusoidally oscillating price curve and an ideal sort of laboratory environment to see how things perform, but that's not going to satisfy anyone, right? I think at the end of the day, we know that the cryptocurrency markets don't look anywhere that neat, and so if you're going to simulate something, why not simulate an actual price chart? And so the one that I was asked to simulate by one of my friends is the Bitcoin price chart, and from the last year. And I chose to start the simulation on the 10th of June. And the reason for that is that was kind of where Bitcoin started to fall off a cliff, and you get this very distinct downtrend. And so I think for a trading protocol to really be worth its mettle, there needs to be options to be profitable during such a sustained downtrend. And it's going to be interesting to see how these three protocols, or how these three different types of liquidity protocol compare against each other when you have like such a strong and sustained downtrend like that. And so now we're back to our prototypical users, or I think I've changed their identities around here. In this case, Alice is going to be using constant product. And we're going to give, again, each one of them $10,000 in value. So Alice is going to be starting with 0.1729 Bitcoins and 5,000 USDC. And if you want to, you can just confirm my math there. And if you multiply $28,915.72 by 0.1729, you will get 5,000. And so you can confirm that Alice actually does have $10,000 worth of total value. Now, what I am going to do here, because we're talking about strategy development, I'm going to depart a little bit from this specific requirement we had in that overly clinical example that we analyzed before, where I actually do want the concentrated liquidity providers to be able to provide single-sided liquidity, right? Because if you were trading, back in June of last year, it was, people were pretty convinced that we were entering a bear market, and so calling the bottom and setting up liquidity provision positions where you think there's going to be a lot of, of volume towards the downside means that you wouldn't really be wanting to provide liquidity on both sides because you might lose a lot of money. So we're going to assume that a sophisticated Uniswap v3 liquidity provider is not going to be providing WBTC, but they will be providing USDC at a certain price target. Now, that price target, in order to make sure that our comparisons, remain pretty good between the concentrated liquidity product and the asymmetric one, I will be using that same price range, but just like we did with the sinusoidal oscillator, that price range is going to be split directly down the middle. So again, if you want to confirm my math there, if you just multiply 17,900 by 20,500 and take the square root, you will get 19,156 or thereabouts. And so all we've done is we've taken the prototypical concentrated liquidity band that Bob has chosen for himself and said, okay, let's emulate what that would look like on Carbon, where the top half of that band is being used to sell BTC for USD, and where the bottom half of that band is being used to sell USDC for BTC. So let's start with the constant product dynamics. So some may, I hope that this isn't inducing any trauma in anyone who was, paying attention to the Bitcoin charts during this time. But again, let's just recall what's happening here. So again, here I think I'm still using a 0.3% fee. I might have been using a 1% fee in those laboratory tests, but whatever, it doesn't matter. This is the one that matters. This is definitely a 0.3% fee. And so you can see the fee growth is pretty lackluster. You can also see that the amount of Bitcoin liquidity associated with with constant product is really quite dismally small. It just looks like a straight line at the bottom of the chart. It's very, very, very thin. And this is actually, it gets thinner and thinner the more valuable your token is, by the way. You'll also note that no matter which way the volatility is, right, the performance goes down, right? And this is what we call a short gamma strategy, right? If the price moves in any direction, if that ends up losing you money, then that's short gamma. And you can see that that's true, right? If you actually kind of drew a straight line through this price chart, and yeah, there's the big one. If you draw a straight line through this price chart and just say, everything on the top should be mirrored and flipped onto the bottom, sort of, and scaled, then you will get this type of pattern. And so, maybe for some people it's surprising that the constant product wasn't so bad at this stage, right? This was a pretty deep capitulation, right? They were now down minus 50% for Bitcoin, but the overall performance of constant product wasn't that bad, right? It was about minus 2-ish% or something, but not overall, not catastrophic. Okay, what about the concentrated liquidity one? So I've chosen, again, that band, and obviously I can see the Bitcoin chart. And so I chose a band where I thought we would get, that would make, the proponents of concentrated liquidity happy, right? So you can see that as the price enters this band, obviously the Bitcoin's, patented volatility is playing out here, and you can see the violence in the depth chart reacting to that. But here, right, you can see as the price is moving out of this liquidity band, everything kind of stabilizes because the liquidity provider is now essentially just HODLing USDC. But then when the price action moves back into this band, then they've got an opportunity to earn some fees there, and you can see their fee earnings are actually pretty good. They're now up quite a bit, right? This is like Uniswap V3 at its best, right? We're now up at about plus 10%. I think it gets about as high as like plus 12, right? So this is, when you see people say, look at all the profits that I've made using concentrated liquidity, this is the kind of thing that they're talking about. But yeah, right there, right? During that very fast crash, all of a sudden, you're actually back below HODL. And these are the kinds of things that tend to be forgotten, or at least they're underappreciated in my view, which is that you can be successful for a very long period of time, but it only takes a few minutes to completely wipe that out. And this is like one of the dangers of concentrated liquidity. Okay, let's move on to the asymmetric liquidity paradigm. But before that, just remember where we ended up, right? This performance versus HODL chart, in my opinion, is the most important one. And it ended up, it maxed out at about 12%. And then it kind of came back, went a little bit negative, and then sort of stabilized at about parity. But I'll show you the results at the end of the simulation. All right, asymmetric liquidity. Again, exactly the same price chart, but note that there's this gap now between the buying and selling ranges. Because remember, we've split this in half, which means that USDC is actually now more concentrated towards this bottom part. You'll also notice that the mechanics are dramatically different, because during a lot of this period, right, everything is flat, right? We're not getting any fees. No one's trading. There's basically zero volume. But look at the performance versus HODL chart. We're already up to plus 20%. There's no fees, right? There's no volume through the protocol, and we're already at twice what the concentrated liquidity example was. You'll see again, occasionally it moves back into range, and every time it sort of spikes down like that, this is that liquidity provider using Carbon to basically buy that asset at a discount, and then as it spikes back up, immediately sell it at a profit. So we're already up to plus 40%, and this is not even a year on the Bitcoin chart. Obviously, you'd have to be very lucky to kind of choose this. And then here's that same capitulation, but on an asymmetric protocol. We only brought the performance versus HODL down to 20%. It's still plus 20%. So it's much less sensitive to these kinds of sort of catastrophic catastrophic events than a traditional concentrated liquidity protocol is. And so if that doesn't, demonstrate the, the power of what it is we're designing and building here, I'm not sure what does. And if anyone wants to see these animations again, or if they want access to the data frames that describe them again, please just reach out to me. I'm not keeping any of this secret. And also, if you would like to see the ranges put somewhere else. Like maybe you're convinced that I cherry picked a certain example or something like that. I will run anything that you want me to. So if it's this Bitcoin chart or if it's another chart that you have in mind, just reach out to me or reach out to Jen or whomever, and I will prepare that animation and I'll share it with you, and I will also send you the binaries or print out a CSV or whatever you want. It's actually fairly easy for me to run a very large number of these. And remember, I also said that the simulator also prints out a report in real time in English of what it's doing. And so, even though it's a very large number of steps, you can actually just read it step by step and confirm for yourself that the math checks out at every single stage. So I'm very confident in its accuracy. There are obviously a couple of assumptions and things that I had to make about efficient markets and other things, but really, in the scheme of things, what I'm trying to demonstrate here is just that if your strategy is to buy low and sell high, you generally do a lot better than if your strategy is to try and earn as much fees as possible and move your liquidity around such that you're always very close to the market price. Right? There are advantages to being far away from the market price sometimes, and then waiting for the market to come to you rather than constantly chasing after the market. Okay, so what are the results? Remember, this was the setup. Everyone's got $10,000 worth of value, although Alice, because she's using constant product, has no choice but to start 50-50 in BTC and USDC, whereas Bob and Charlie are both using USDC exclusively. Okay, so Alice on the constant product made a $2,246 loss, I think. Bob made a $61.93 profit, and that's the concentrated liquidity, or the prototypical concentrated liquidity example. Whereas the asymmetric example, which is what Carbon is representing, profited by $2,846.90. And this is using exactly the same price chart, obviously different protocols and different approaches. Obviously, there's not much we can do for the constant product case because it can only trade the way that it trades. Like I said, we can choose different ranges for Bob to trade. And also we can simulate things like him withdrawing at certain situations and redepositing and things like that. And if you want me to do those things to see just how profitable we can make the concentrated liquidity paradigm, I'm right there with you, right? I'm also academically driven to investigate these things. And so optimizing for a standard concentrated liquidity simulation is right up my alley. But what I have found is that anything that looks good for a standard concentrated position, you can make a lot better by introducing some asymmetry into there. And I think that anyone that has done a lot of trading analysis will tell you that asymmetry is key anyway, right? So it shouldn't be controversial to anyone, at least outside of DeFi. Maybe within DeFi, it's a new concept. And so that's where we're at. thank you for your patience. It took me a little while to get all of these things up and running, but I'm pleased to report that now that I've got the code base under me, can start generating this kind of material pretty quickly. One of the ambitions that I have is to sort of include it somewhere, like on a web page or in Databricks as a part of our analysis suite, or whatever it is that we decide to do with it, so that people can feed it or select certain price charts that they want to backtest. And then it would deliver this animation or a subset of those animations for them, with a link or something where they can be invited to tweet about their results, or that kind of thing. But if we have this sort of quality of information and simulation, I'm hoping that we can reach a very wide and very engaged audience of traders who are interested, or are not just interested in using the product, but also understanding it and improving the theory that we're working with here, because it is relatively new ground. But I think that's the end of the presentation, so I'm happy to take any questions, but otherwise, I think this will be on YouTube as usual. But yeah, if you want anything in it, like any of the animations or data itself, like I said, just ask. And if you want me to run a simulation for you before the tool is available to you, just let me know what that is, and I'll be happy to do it as well. So thank you for your attention.
Mark, thank you so much for preparing all of that. I personally have a couple of questions. One is, it'll obviously be made available, but do you know will it be available when Carbon launches, or will it be made available prior to?
Not sure. Technically, I can make it available now. It's just that it needs a little bit of hand holding. So if there's someone that's got a good deal of you know of if you've got your sea legs under you with Python, then you can just have it right now. I don't mind just sending you the notebook. In terms of making it sort of user friendly enough that it will have like a nice UI or something, that you can that someone without any programming background would be able to use confidently. I'm not really sure, but I think I have. It's a question of priorities right now. But yeah, look, I think around the time the Carbon launches, I would be extremely disappointed if we didn't have it out before then or during that time, right? Because I think that it's going to have a huge amount of marketing value, and that it will drive more attention to what it is that we're doing. So if it's not out by that time, I will be deeply disappointed.
You're talking about with a nice, like, user-friendly version with the UI and everything else, is what you're talking about at
Yeah,
at launch time?
yeah, kind of like how the IL, the WTF campaign worked, where people were suddenly had the access to this ability to analyze their IL and what their liquidity activities across DeFi had netted them. I think that kind of what I learned from that experience is that people like to use these analysis tools, and if you make it easy for and convenient for them to share the results, they will. And I think something like this, where you can, where I challenge people to actually find, strategies on any of these three protocols, right? Like, it would be really interesting to find a situation um, where standard constant product is the best of the three, or have a situation where standard concentrated liquidity is the best of the three, and those kinds of things. I just know that once people get their hands on it and want to want to delve into it and try and get certain behaviors out of it, that they will. And I think in order for that to be successful, it needs to be super easy, right? Like, laughably convenient to run stuff, and that's going to take a little bit more effort.
Right. Okay. That sounds good. Maybe I can just backtrack a little bit to when you were talking about the fees. One, this visual really helped me personally. We were talking on the Twitter Spaces about how the spread equals the fee, but having the
Mm-hmm.
visual there and kind of going over it again made it really clear to me. So thanks for pointing that out. Um, when you're talking about the fees that are earned, at the end of the day, when you were showing the results for constant product, that is their end result, including the fees that they've earned, correct? Same thing with the concentrated liquidity?
Yes, exactly. So,
Okay.
so if we go to the constant product one, the way that you measure the fees in constant product is you compare the K value at the since the beginning of this liquidity provider's journey, right? So you can just look back in time and say, okay, if you contributed 100 tokens and 10 tokens and 10 times 1,000, and sorry, 10 times 100 is 1,000, and now I look at what you've got now, all I have to do is multiply those two tokens together again, and that's going to give me a new number that's going to be greater than 1,000, right? Because any trade on an AMM causes that K value to increase. And so you just compare those two values, and you take a square root and do a division, and it will tell you how many of those tokens on both sides can now be attributed to fee growth. But it won't tell you, it won't tell you necessarily which tokens have been paid in fees, right? Because once you kind of mix them together, it's impossible to separate them, or at least it's not easy to separate them, which is why they have roughly the same height. Whereas in the concentrated liquidity case, the fee earnings are outside of the liquidity, right? When you've got your like Uniswap V3 NFT, and you go and have a look at the fee growth component, it is those tokens are stored separately. They're not a part of the liquidity that's being added. And yeah, so what we do when we're looking at that performance versus HODL, we take the total liquidity that they still have withdrawable in their position, and we multiply the amount of the amount of TKN, right, by whatever its current dollar value is. And then we also look at the amount of USDC that they have in fees. And we also have a look at the amount of TKN that they have in fees and multiply that by the current price. So we sum everything together, and that is what goes into the performance versus HODL, and that's why you can see it grow.
Okay.
If we didn't, it would just move to the right, and would never move up.
Right. Okay. So
But
then
but with
this
yeah,
is
but with the
really
asymmetric
quickly.
with the a
Wait,
yeah, huh.
wait. Before we
Okay,
go
sure.
on, asymmetric liquidity, really quickly, I just want to make sure I'm understanding. This bottom line then for constant product and concentrated liquidity is pretty much like the IL combined with the fees earned to give us that bottom figure, that bottom line.
What do you mean by bottom line?
I mean, the end result, the numbers that you shared at the very end. Like for
Oh,
constant
yeah.
product. Okay. Okay. Now
Yeah,
let's move on to asymmetric liquidity then.
yeah, IL is just like one component of the analysis.
Right.
But we're just looking at the overall performance, right? And so
Right.
IL is like a component of that, but it's not the only part.
Right.
But okay, yeah. So for fee stuff, the this one is different, because on Carbon, the fees aren't owned by the liquidity provider; they're owned by the protocol. And so we don't add the fees to this position, which is surprising, right? Because what we're demonstrating here is that the system it's not just more performant than its predecessor designs, but it's more performant than its predecessors in spite of it not earning any fees, right, by the liquidity provider. So obviously, the protocol, its performance versus HODL is just a very slow creeping line up and to the right, because it doesn't provide its own liquidity the way it did in V2.1 and V3. It's just kind of a silent spectator. But yeah, that's the point that I want to stress, right? It might be unfair. Maybe I should put a different color on it or an asterisk or something here, because I don't want it to be misconstrued that these fee earnings, in the case of asymmetric liquidity, are owed to the user. They're not, but it doesn't seem to matter, because even with those fee earnings not being attributed to the performance versus HODL chart, the performance versus HODL chart continues to look great anyway.
Right. Okay. So I guess what I just wanted to clarify was with Carbon, this strategy, I mean, this is 46 times more profitable than concentrated
Yeah,
liquidity. And they're
yeah.
not
I
earning the
mean,
fees. The fees go to Carbon. And this is what the DAO was
Exactly.
talking about. This is what we were talking about with alleviating the deficit. If the DAO votes on these fees going towards buying and burning BNT, that's where that's coming from. And that's not affecting the users at all when it comes to
Exactly.
this performance versus HODL chart that you're showing us.
Yeah, exactly. And that's like, that's been, I think, the most significant challenge with, um, you know, with designing, with the process leading up to the design of Carbon. Because you can't have something that, by virtue of the fact that we need to, by virtue of the fact that we need to recover the protocol deficit somehow, you can't have something that is then less attractive to use compared to its competitor protocols. You need to have something that is both more attractive to use, or at least appealing to an unserved niche, and is also earning money for itself, right? It needs to be an actual business model. And I think that a lot of DeFi protocols, ours included, we didn't really have that sort of mentality when when our community was really excited for things like liquidity mining and other things. And so this one, what we're trying to do here is you need to provide value to the end user, but then the protocol also needs to garner value for itself. Otherwise, you don't have something very interesting. And it's not contingent on liquidity mining or anything else. It should be self-incentivizing, right? It's the utility that you get from using it that should be the singular driving force for its consumer base. And I think that that's what we have here.
Awesome. Thank you. I just wanted to make sure that I was understanding, and as long as I am and I'm clarifying, hopefully, our listeners can understand that as well. Does anybody else have any questions? I don't see any hands up, but we also have our chat. Glenn, maybe if you haven't already, you can, oh, you did. Bring attention to the live stage calls channel that we have for any questions. Mark, tax implications are a really funky sort of thing. I think that would probably take maybe like a tax lawyer or somebody to kind of speak to. I don't know about that, Mark. I don't know if you even want to speak to that one
I don't.
either.
I think with as with anything in DeFi, consult a tax attorney. It's that simple.
Cool. Okay. Well, if any other questions do come up, if anyone has any, even following this demonstration or this presentation, please write them in that channel. And if I can answer them, I will. Otherwise, I'll bring it to Mark's attention. And like he said, if there's something that you guys, anybody wants to see, any particular price ranges or price charts, please go ahead and reach out to me, and we'll get those made for you. I think the kind of cool thing about this, and I was saying this in the coffee break really fast before we end the call, Mark, and thank you again for doing this, is for a new user, obviously we'll all be new users of Carbon, but for somebody who's not exactly a trader, this is such a fantastic tool for me to not only see why I wasn't exactly profitable as like an LP, but to also kind of test my own strategies before I actually go ahead and create them on Carbon. So it's like a big confidence
Exactly.
builder, you know what I mean? To be able to say like, okay, maybe I do know what I'm doing, and I can test my strategies before I actually deploy them and make them live on Carbon. So awesome. Well,
Yeah,
thank you, Mark.
exactly.
Thank you
Yeah,
so
it's fine.
much for preparing this, and I look forward to it. You'll keep us updated then, I'm assuming, on when this can be made public and available to users to actually produce results on their own, right?
Yeah, well, like I said, if anyone feels like they've got if if they don't mind working with code in progress, I don't mind sharing it. Right, there's no reason for me to keep the secret. Obviously, there was once upon a time, but with with all of our public disclosures and things out of the way, There's really no, I don't take any issue with just sharing it as it is. Just know that at the moment it's not very pretty. I'm in the process of annotating it better. And some of my doc strings aren't as helpful as they can be and that kind of thing. There's also a fair bit of redundancy in it right now, and so it's not the most it's not the most efficient of code. But if you've got it's not that complicated, especially if you're running it you can run it without the animation, just to get a historical analysis, and it does that very, very, very quickly. So it can process, the point is that it's done. There's a lot of theory in it already built in. I've tried to make it as easy to use, and if someone has the interest, and even if you don't have the skills, if you just want to see what it takes to run it, I'm happy to demonstrate that as well. Maybe we can do that during a DAO discussion or something. But yeah, this is just a very long and rambling way of saying, in my view, it's already in a state where I'm comfortable sharing it, right? I'm confident that I can give it to someone and be like, look, this is how you do it. Just like prepare your price chart this way, and call these functions in this order, and go and make a coffee while it runs. I'm 100% confident that anyone with even rudimentary Python experience would be able to make it do whatever they wanted it to do. But in terms of sharing it in the sense of having some pip installer, or having it be available from out of the browser to run arbitrary stuff, or having a GUI or something, that kind of stuff, I'm not really sure, but I'd be happy to update everyone. But actually, I'm more interested in just giving people the code and seeing what they do with it, right? I think that it would be a good community project now that it's kind of got legs under it.
Yeah, absolutely. Okay. Well, awesome. Thank you again so much. And thank you to everybody who joined. Again, reach out if you have any questions. Otherwise, we will be putting this one up on YouTube, and hopefully we'll have more questions coming in as, more eyes. Mark, thank you.
My pleasure. Anytime.
And thank you guys.